Welcome to Yadnya Investment Academy. Today we are going to talk about one of the most sought after topics as far as mutual funds are concerned, which is when should you sell or exit a mutual fund. The typical reasons why people think that they should sell off their mutual funds are that the market is at all-time high, your fund has performed extremely well, and you now want to book profits. The second reason why they think that they should exit a mutual fund is because the market is down, your fund has given negative returns, and you now want to exit to avoid any further losses. And the third reason why people think that they should sell off their mutual fund is because the fund is performing below its peers. Many a times it is just for a couple of months, the fund may be underperforming, making us think that the fund is not good enough. Now this becomes a bigger problem when you start understanding many parameters which help you evaluate performance of a fund. But as Yadnya educates you how to evaluate performance of a fund, it becomes our responsibility to even remind you while discussing various topics as not to be anxious when a fund underperforms for a couple of months. Now, if any of these reasons make you feel that you should sell off a mutual fund, then such selling decisions mostly backfire. Now that we've seen what are the wrong reasons of selling a mutual fund, let us discuss what are the right reasons of selling a mutual fund. We have always been emphasizing that all your investments should be tied to your financial goals. So you should sell off your mutual fund if you have achieved your goal in monetary terms. Let us take an example to understand this better. There are many financial goal planners as well as calculators available online. If you put in data related to your goal in it, it tells you the amount of investment you would need each month to reach your goal, along with the future cost of your goal. So let us assume here there is our favorite Mr. A. In June 2003, when his child was 7 years old, he took up a goal of sending his child for higher education in the future. The cost of desired education as of June 2003 was 10 lakh rupees. So in your financial goal planner online, you would have to put in the current cost of your desired goal, the assumed rate of inflation, here it is assumed at 8% on a per annum basis. The investment horizon, in this case it is 14 years, as Mr. A would need the corpus when his child becomes 21 years old. You would have to put in your expected rate of return. Mr. A is an aggressive investor. His investment horizon is more than 10 years away. So he is comfortable putting his investment into small and mid-cap funds, which is a right kind of fund for investment horizon more than 10 years away. So putting in expected rate of return of 12% on a per annum basis, the SIP amount is calculated as 6,730 rupees and the future cost of the goal is 29.37 lakh rupees. Based upon all this information, Mr. A invested 7,000 rupees each month in Franklin India Prima Fund Growth Option, which is a mid-cap fund. He started his investments in June 2003. The investment horizon was supposed to end in May 2017, but as of June 2014 itself, the value of his investment was 27.28 lakh rupees for a total investment of 9.31 lakh rupees. The CAGR he got for his investment was 18.46%. Now Mr. A was expecting returns of around 12% on a per annum basis on his investment, but he got returns of 18.46% on a per annum basis on his investment. Due to this high CAGR, he reached his goal 3 years before time itself. So what should Mr. A do now? Since he's already achieved his goal, he should take out his money from equity investments and put them into safe avenues like debt funds. Debt funds would give him returns around inflation, which would preserve his capital till he actually needs it and also would save him from market volatility in the ending years. But what if you've not been as lucky as Mr. A to get a higher CAGR than expected, but you're on track, you're getting returns as expected? Even then, you should shift your investments from equity to debt when you are 1 to 3 years away from your goal. This would save you from market volatility in the ending years. But what if the market moves down when you're about to shift your equity investments to debt? Historically, it has been seen that the market would give you a chance of moving out of your investments in a cycle of 3 years. So it is very, very important to track your investments and move out as soon as you achieve them. The second reason why you should sell a mutual fund is if it is underperforming for a long time. If the fund you've invested in is underperforming for more than 3 quarters compared to its peers and benchmark, you should try to find out the reason why it is underperforming. Is it because of change in fund manager, change in fundamental attributes of the fund, or change in mandate of the fund, etc.? Once you've analyzed the reason and you think that the fund can fall back on track, give it some time for recovery. A year's underperformance in case of long good performing funds should not be a reason for your exit from the fund. Let us take an example to understand this. What you see in front of you are quarterly returns of HDFC equity fund belonging to the multi-cap category. The returns have been shown from April 2014, that is quarter ending June 2014 till March 2017. As you can see, the performance of this fund has been below its benchmark Nifty 500 or the category, that is multi-cap category, from July 2014 till March 2016. In the next 3 quarters, the performance of the fund has been average, which again slid below its benchmark and category in the quarter ending March 2017. Now, there has been no change in the mandate of the fund or the fund manager, which could impact the returns of the fund negatively. But if you check the risk return parameters calculated for the last 3 years of this fund, you would see that the beta value and standard deviation indicate that the fund is more volatile in comparison with the benchmark index and category. The Sharpe ratio of this fund is below the benchmark and category, where within the category there are funds which have a Sharpe ratio well above 1. All this indicate that the fund is taking higher risk and is not able to pull out the kind of returns it should, indicating that it is a high risk fund. So if someone invested in this fund in 2014 or before that and noticed that the fund is not performing well for 3 quarters starting July 2014, he should have analyzed for the reasons. If the fundamentals of the fund did not look good, he should have kept an eye on the returns of the fund for the next 2 quarters. And looking at that the fund is not performing well for 6+ quarters, he should have exited the fund. Goal-based investment approach is followed by people who want to satisfy their overwhelming goals with the limited income they have. Asset allocation is followed by people who have surplus income with which they can easily satisfy their goals. So these people follow asset allocation based upon their risk profile, that is their risk-taking capacity. But due to increasing age, sudden windfall they have received, or due to some other reason, there may be change in their risk profile itself. For example, if a person in his young days had an aggressive risk profile where he kept 100% of his allocations to equity, by the time he comes to middle age, might want to adopt a growth profile where he keeps 80% of his allocations to equity and 20% to debt. In that case, he would have to sell some of his equity mutual funds to invest into debt. In that case, it would be fair enough to sell a mutual fund because you're trying to rebalance your portfolio based upon your changing risk profile. So friends, in this video, we have seen the 3 right reasons why you should sell a mutual fund, which are: if you've achieved your goal, you should shift your corpus you've been saving for a long time in equity mutual funds to safe avenues like debt funds. Second reason is, if your fund is underperforming for a long time compared with benchmark and category. Please note, we are saying benchmark and category because at times there might be some other funds which are performing better than yours, but stick to your fund if your fund has been giving you consistent good returns for a long time. And the last reason is, if you're trying to rebalance your portfolio because there's change in your risk profile itself. So friends, hope this video has been useful. Thanks for watching this one. Watch this space for more such topics. Until then, happy investing.